What's going on, guys? Today I have another very exciting video for you. We are getting close to the end of the year, and I have seen a ton of videos, a ton of articles about bear cases for 2023. So I want to turn around and do something contradictory to all of that. I want to present the bull case for 2023. What could happen that could completely turn the stock market around in 2023 and end up with us a lot higher over the next year? So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at the market itself. This is the S&P 500 SPY. We can see that here today we were down 1.18%. Over the last 5 days, down 2.77%. Over the last month, down 2.78%. Over the last 6 months, it gets interesting because we've actually traded kind of sideways. We're up 5%. You can see that the market, ran up in a very significant way, around 17% from June to August. And then from there, the market actually dropped out again, all the way down almost 17% again, and then it ran up over the last few months from September to November. You can see that it ran up almost 15%, and we've started to turn around again where the market looks like it's going to drop back down. So we'll see how far it drops back down. Maybe it'll only drop back down into this kind of 350 range, but otherwise we could see it drop in a very significant way, even further than that if things begin to deteriorate. But in this video, we're going to be talking about the potential bull case that we could see over 2023. And you can see over the last year for 2022, it has been a rough year. We are down on the S&P 500 almost 17%. As we all know, the biggest thing causing this volatility in the market is the Fed. So the Fed is stepping in and they are increasing interest rates and have been in a very significant way. This is actually the first rate increase that we have seen in a while that has been below 0.75%. So that is absolutely insane. The market is starting to at least see a turnaround, but the market kind of had this priced in and was starting to price this in after it ran up so much, after inflation numbers started to come in a little bit lower than people were anticipating. So the Fed, increasing rates by 0.5%, really that's not what drove the market in the downward direction. It's more the comments from Jerome Powell. And the two main talking points from the meeting are kind of with this first comment and then also this second comment. So the first comment up here is the Fed will continue to reduce its holdings of Treasury securities, agency debt, mortgage-backed securities on a monthly basis. The committee anticipates that ongoing increases in the target range will be appropriate to return inflation to its 2% goal. So basically what they're saying is somewhere between a 0.25% increase month over month or a 0.75% increase month over month will get them down to this 2% inflation goal number. And that's really threatening to the market right now, just because we're sitting around like a 7% inflation. We'll take a look at the inflation numbers and where I think they could potentially go over the next year or so. But right now we're sitting around that 7% number. And obviously there's still a long way to go to get to this 2% goal. And that really worries the market, because if the Fed is going to continually increase interest rates, even though, inflation is dropping, what the worry is that they could overshoot it and basically send the US economy into a recession. The second comment is a little bit more bullish in my opinion than the market actually took it. So what we have here is, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So really this important statement is the one in the middle. So the lags with which monetary policy affects economic activity and inflation. So this is massively important. And honestly, what it is stating is that if inflation is dropping in a very meaningful way, there is no need to continue to increase interest rates. So if they can keep them flat and they continue to see inflation falling month over month, then that is going to still be a positive sign for the Fed. It doesn't mean that they need to continue increasing interest rates month over month until they hit that 2% number. It just means they need to get to a number that will continue the trend down to that 2% target goal. And when we start looking at some of the inflation numbers, that's when we can really start potentially painting a bullish picture for 2023. So what we could see in 2021 is that the market or the inflation numbers actually leveled off around the 5% number over that summer. And on the back half of the year, we saw a sharp increase. The inflation number increased all the way to 6.8 and then 7% by the end of the year. And that's really when the Fed started stepping in and implementing a little bit tighter monetary policy. And what we could see is in 2022, that actually allowed for inflation to really level off over the summer. Again, like we've talked about, raising interest rates is a lagging indicator. Basically, they can raise interest rates, but it's not really going to affect these inflation numbers for a few months. For most people say 3 to 6 months at the very least. So what we could see is, again, 3 to 6 months later, in the middle of the summer, we start seeing this 9.1 number, and honestly, the trends start to lower, basically going from 9.1 to 8.5 to 8.3 to 8.2, and then 7.7, and all the way down to 7.1 last month. So we are seeing things start to trend in a very downward direction, and that is positive. That's basically showing the Fed that what they are doing is having an effect. But the other big thing is the comps that we are seeing, right? Right now, over the last couple of months, we've actually started to comp against 6% inflation numbers. So we had 6.2, then we had 6.8, and now in December, we are actually going to be comping against our first 7% inflation number. So it will be very interesting to see if we can actually get our inflation number when it's released in January down to below 6%. And that's where things get very interesting, in my opinion, because over the next 3 months, we actually went from a 7% inflation number all the way up to an 8.5% inflation number. So that is a 1.5 increase in inflation. And what that could mean is that over the next 3 to 4 months, as we start seeing these numbers come out for inflation, we could potentially see a number in a very bullish case around 5%. I think 5 to 5.5% would be a very interesting and very positive number. If we were able to hit that by the end of March, or the number basically being released in April, I think that would get the Fed in a very confident mindset moving into the back half of the year, where they could potentially freeze interest rates over the next 6 months and basically just let things kind of play out in 2023. And I think the stock market, based off how they have things priced in right now, as long as we don't get major layoffs, the stock market could react in a very positive way. We could start seeing money come back into the market, and a lot of these more speculative stocks, if they're able to weather the storm for the first 6 months of 2023 and interest rates start to level off, I think that is going to basically expose a lot of these more speculative businesses, a lot of these businesses that have debt, to a lot less volatility in the stock market. One argument that I've seen a lot over the last few weeks has been that a lot of layoffs are going to be coming down the pipeline. We could see here that this was posted yesterday, this article, and Goldman Sachs is planning to cut up to 8% of its employees in January. So obviously this is a very negative thing, right? This is very negative to have anyone, losing their job, because what ends up happening is now these people don't have money to spend in the economy and basically keep the economic wheel turning. But I would have a counter argument to this, right? Over the next 6 months, if we see some layoffs, and I'm not talking about a very significant amount, right? If we start seeing huge numbers of layoffs, that could have a very negative impact on the economy. But if we start seeing kind of some of these smaller percent numbers, maybe see unemployment, go up to like a 3 to 5% range, I don't think it's going to have a massive impact on the economy, because what we can see right now is a lot of these higher end tech jobs and basically higher end jobs, like Goldman Sachs, they have overhired over the last 2 years. We have seen these companies basically increase their workforces, over the last 2 to 5 years by, in some cases, over 200%. And these are absolutely insane numbers that we've seen. And a lot of that coming, over the last 6 to 24 months. And really what that results in is an inflation of these numbers of the employees at the top end of the market. A lot of these top earners, like we've talked about, Google is paying its employees, its average employee salary is around like $250,000. So we're seeing a lot of people earning a lot of money, and that is obviously having an impact on inflation, and that's also having an impact, on basically these businesses, because they have very high expenses. So when we see these employees basically cut from, their jobs, potentially they will move down to lower firms. Basically, you might go from a Google down to, a Snapchat or something that's kind of a smaller firm, a smaller company that doesn't, pay as well. And then you see that kind of continue throughout the economy. It will take a number, of months to really continue all the way down, but we still have, and something that I think people are kind of forgetting is if you go out to any retail store, any food industry company, McDonald's, Wendy's, Burger King, whatever it may be, they all still have hiring signs in their windows. So that is very important to remember. We still have a huge gap at the lower end of the market. These aren't the same high paying jobs. These aren't those big tech companies where you're going to be making $250,000 a year. But we still do have openings where people will have money. They will just have a little bit less money. And obviously that could actually have a positive impact on these inflation numbers, because right now what we're seeing is the supply chain is all messed up and still continues to be a little bit messed up. It's corrected itself a little bit over the last 6 to 12 months, but we're still seeing issues with delays in receiving equipment and things like that because of how much people are buying and people are spending. So if we start seeing a lot of those purchasing numbers start coming down and people having less money to spend, this will actually have a positive impact as well on inflation and could end up being a bullish indicator for the stock market in general. Those are the two biggest bearish arguments that I've heard in the stock market recently. Basically that inflation is going to continue rising, or basically that the Fed is going to have to keep increasing their interest rates. And I think what we've kind of looked at here today, they could potentially level off their interest rates and things could, end up being fine. And then same thing with layoffs being a potential huge impact on the economy. Again, that is true. If we see massive layoffs, I do agree that it could have a huge impact on the economy, but there are also a large number of openings still at the lower end of the job market, and that could have its own positive impact on inflation by reducing the amount of income that a lot of these higher earners have right now in the economy. So overall, I think those are two things that need to be kind of taken into account. I do think there is right now a large lean towards a potential recession or very bearish market in 2023, and I tend to be a contrarian where if a lot of people are leaning a certain way, I tend to think the opposite. I think that 2023 could be a great time to be invested in the stock market, and I tend to be positive about where the market is headed over time and over the long term. We can see here that since the inception of SPY in 1993, that the market is up 772%. So we could definitely see that trend continue, in my opinion. So overall, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.